So we're here to talk about brokerages investing in commercial real estate tech. And maybe to kick us off, if you could tell us both what your company is actually doing on that front, but maybe more importantly, why now? Jake.
We're doing a lot. Yesterday actually was our demo day. We have a partnership with Techstars. So we had 10 companies go through the accelerator program. We invested in these companies and then mentored them over the last 12 weeks. They had a demo day, Tuesday. So we're really excited about that investment. It's a way for us to get involved with early stage companies that have obviously potential financial gain, but also strategic value to our overall technology plan. So we're really excited about that program.
And why now? When did you establish that program, and what was the triggering event?
Well, this was our first class with Techstars, but the technology initiative has been going on for years. It was just one example of things that we're trying to do to stay ahead of the curve. I think that the reason that this has grown to the level that it's grown, a lot of it has to do with VC money coming in, flooding into the industry. I actually started a CREtech company 5 years ago, and this event was very different. It was
people were quieter back then.
People were confused. It seemed very niche, right? And there wasn't nearly as many booths and not nearly as many people participating. But there was a few early successes. VCs started recognizing the potential in the space, and so money is just flooded in. And when that happens, more companies see the opportunity and start innovating and trying to find ways to use technology to improve the daily lives of the firms as well as the individuals.
Raj.
Newmark's been investing fairly heavily in the last few years. I think we try to keep it low key. A couple of the investments that are out there in the public domain are Notel and Workframe. To answer your question of why now, I think I started with the firm 4 years ago, and we believe the market has matured, and the recent wave of technology changes and advancements are very in line with what commercial real estate needs. I think between the sophistication, the higher expectations from the participants in the space, and things like basic technologies like cloud and mobility and these things for a diverse national workforce, those two converging at the same time is probably why all of this investment is taking place right now.
I see. Patrick.
So Savills Studley is investing quite a bit internally. I think the fellow from Deloitte was talking a little bit about how they're activating concepts and proof of concepts internally. So we've got some key strategic partnerships with some of the best data visualization software companies out there. We've got key strategic partnerships that we're developing to enhance our overall data foundation for our brokers, our internal clients. And we're actively investing through an arm that we call Grosvenor Investments through Savills, and what we see as strategic and financially advantaged sort of next generation brokerage concepts, enhancements, and ultimately we're trying to future-proof our platform, right? We've got customer expectations both from a broker perspective as well as an external customer that have shifted significantly, and we recognize that. And I think macro level, you've seen a lot of capital coming to what is generally a late stage adopter as a vertical. So there's a lot of untouched concepts that good minds are coming to and really thinking about how they can solve those types of issues. And as we see that, we want to make sure that we're making those key investments as an organization. So,
Sandy.
Yeah, at Meridian, we've been investing about 75% heavily internally and 25% externally. For us, as a company that's been around for 27 years, we have an enormous wealth of data. And there's an enormous amount of public data available from companies like, Reonomy and Property Shark. And our investments are really focusing around uncovering the nuggets of information in the data, because that's driving better lead generation and better information about what's going on in the market as we continue to grow our business.
Andrea.
So if you're asking why now, my answer is why not?
Can you hold the mic a little closer to you?
Oh, okay. I'd say commercial real estate is probably one of the last industries to get into technology. And if you think about, everyone here is talking about data and like aggregating data and figuring out what to do with it. I'm going to also think about from a recruitment standpoint, how are you going to be able to recruit a new generation if all of your processes are still manual? And so we've been looking at technologies that can help automate a lot of manual processes, and also just supercharge our real estate professionals with innovative technologies that allow them and our clients to do their work better and have better insights on their real estate portfolios.
So you mentioned the area of recruitment. What attracted you to JLL, and what maybe other alternatives were you considering before? Did you imagine that you'll become a real estate professional, or did you have other plans? And
I grew up in a real estate family, and I studied, traditional real estate finance. So I think it made sense to start at JLL over 9 years ago. But then the transition to JLL Spark I started thinking more about technology a couple of years ago when I started working very closely with honest buildings, and I realized that, if I want to still have a job in the next 10 years, I should probably start getting more involved with the startup space, technologies, and with JLL's goals and mandates of becoming a technology powerhouse for real estate professionals. I think this is a really good time, or a really good opportunity for me to bridge the gap between real estate and technology.
And so with JLL specifically, it's structured as a venture fund, as a separate fund, if I'm correct. How do you balance the kind of strategic imperatives and the financial imperatives when you make investments? So the stuff that would be useful for the company, but maybe might not necessarily be a home run as an investment, compared to stuff that might be a great investment, but maybe you're not sure how you could use it internally yet.
So JLL Spark is a separate entity from JLL. We roll up to the global level. So LaSalle, JLL, and JLL Spark are the three separate entities under the whole JLL incorporated umbrella. And so our mandates as a strategic fund is to invest in technologies that have applicability to either JLL, LaSalle, or other clients of JLL or LaSalle. In doing so, we want to get technologies we want JLL and LaSalle to have first mover advantage with technology. So we most likely are not going to be investing in technologies, even if they're game changing, if there's not any way for JLL or LaSalle to add strategic value.
Sandy, so you mentioned the 75% investing in internal innovation, 25% in external stuff. So likewise, for the external stuff, is it more a strategic imperative, financial?
Well, our goals are very simple. First, we're either trying to solve an existing problem or pain point. 2, we're trying to drive revenue. And 3, overall, just making our company more efficient in a collaborative manner. So anything that we're looking at has to meet one of those 3 criterias, whether even, to your point, Andrea, of being, really cool technology, we're not going to look at it because it really doesn't add any value. And I will say, one of the challenges that I think a lot of people try and find or do is put out technology where there's no true return on investment. So it's got to have some kind of return, whether it's tangible or intangible.
Patrick.
Yeah, I would just add that strategic could be code word for I can't make a financial business case for it. So that's not necessarily a great investment, potentially, if it's running under the guise of strategic. But I think from our perspective, it's about how do you build a business case internally, right? We want to make sure that we're getting our investor capital to the best return. That return could be enhanced and augmented if it's a strategic investment. But if you can't communicate that and articulate that clearly and stand behind it and have executive sponsorship and accountability for execution, then it's probably not a good fit for us.
Thank you. Raj.
So I'm going to echo the other panelists. For us, for the most part, it's not about the equity upside in the investment. It has to fit into our strategic goals as far as a real estate platform is concerned. And it's not about how cool the technology is. I think, if anything, one of the filters that I think most of the CREtech vendors, I think, don't appreciate as much as they should is, for us, the solution needs to fit in holistically into the platform. If it's a solution that results in a new silo, it could be cool and flashy, but we try to avoid that. It has to make sense for the entire platform, and I've had many meetings with firms with very good technology, but when I try to think of using that technology for the entire firm, there's not an easy path forward. So just to add on to what the other panelists are saying, I think that's also a key driver, that it not only, of course, obviously enhances our platform, but makes sense holistically.
I would just add, I think one of the challenges we've had with that is sometimes the pre-existing platform isn't necessarily the platform for the next generation of customer. Mm-hmm. And one of the things that we've been thinking about, which I'm sure you're thinking about as well, is kind of how do you create enough independence and autonomy so that these new ideas that may not necessarily look like they're a fit for the platform today are still in the queue, and you've got a forward look on those types of opportunities.
Completely agree, but when I said platform, I meant our business platform, our real estate offering, our capital markets, our leasing, our corporate services business, not the technology, yeah.
Jake.
And in addition to that, I think we also think about how can it help our clients or our customers, right? And how does it fit into their platform? So a couple of things. One, we want to continue to better our service, but also we can help the CREtech company get customers, right? So if it's something that we feel like would be valuable for our customers, we could help them with introductions and things like that. So it could be strategic in that way as well. I think it's a typical outlook, though. Most VC partners, they invest in what they know, right? So we know real estate, and we understand how the technology will fit into the business, and therefore that's the investments that we're making.
And so a couple of you mentioned also serving your investors or the interests of your investors with these type of investments. I don't think all of you actually deploy external capital into these PropTech investments. So if you can explain the model with which you invest. Is it your own balance sheet money? Is it a commingled fund with other investors that you have? Is it something else?
Ours is an internal fund.
Internal fund?
Yeah, it's part of Colliers International.
I don't want to get into the details internally, but Newmark until recently was a part of BGC, and we have a sister group of companies, Cantor Fitzgerald and others that are in the investment banking. So it's a combination of those as far as our presence is concerned, but I'd rather not get into the details.
Okay.
Yeah, both. I mean, we have the separate arm that I mentioned, which is the Grosvenor Fund through the UK. That is a separate entity, but internally, I mean, it's essentially our shareholder money, and it's our client constituency, and it's our broker constituency that's making that investment. So we're a proxy for redeploying that capital into the next generation of the platform.
I see. Meridian?
Well, we don't necessarily invest in companies. I will say that when you form a relationship with a startup company, you're investing in them, because if you enter into a relationship and they don't survive and they go out of business, you've got a capital loss of another kind, because you're investing time in your people and your systems. So I think you're also making a commitment to the team, to the people and the platform. So even as a client or a customer, you're still looking at it from a very similar perspective.
I see.
So as I mentioned earlier, Spark is a wholly owned business under the JLL Incorporated global umbrella.
Then all of the capital just comes from within the group, no external investors beyond that?
No external investors, no.
Okay. Raj, you mentioned, I think before, the idea of actually getting adoption internally. What are the main barriers that you see to that? Or basically, what have you been facing in trying to actually get people to adopt these amazing things that maybe you found and thought would be useful to them? Is it enough to just tell them about it, or?
Well, I think but it's the carrot or the stick sometimes as far as the strategy is concerned, and most technologists, I think, look too much on the stick approach. And I think that rarely works long term. So it has to be always the carrot approach in my mind. And when I say carrot, it has to be also self-evident. Webinars, training, they're good, they're needed, and we do them like everybody else, but I think the value add, the value proposition should be self-evident. And it's surprising how sometimes simple is adopted much more quicker than sophisticated. You can, for example, one of the things we're doing is 100% cloud, right? All email, all applications, all storage. It's pretty universal. My 12-year-old son has better technology in his public school than a lot of professionals making millions of dollars. So things like that, self-evident, it's mobile, it's available, the data is there, there are insights, it's not a complicated dashboard. There are power users, but for the most part, simple and self-evident is the goal, I think.
Jake?
Yeah, I think when you work in a large organization, it's hard to get the word out. So we spend a lot of time thinking through our communication strategy, making people aware of what is available. We built actually technology to make it easier for us to deliver in a variety of different channels. But to Raj's point, simple and easy to understand the value, those things typically get adopted. We've tried to roll out some more complex things or third-party partnerships. And that messaging is difficult, and we don't have the resources to sit down with each individual. I mean, we have 6,000 brokers in the U.S., right? So you can't have a one-on-one conversation to explain to them why something is important. So, that's typically what we're doing internally. We're also building out a customer success team, just like you would see in any other technology company, to be proactive. So instead of just giving demos or, setting up webinars and sending out an email, they're tracking user metrics and actually proactively reaching out to users to reinforce the value and help them understand, how to use the technology. And that's increased, since we started the program, has increased adoption significantly.
Andrea, same questions, but maybe with a little more top spin. Do you, prior to an investment, bring some of the stuff to the actual operating teams and checking with them, getting them to test things, or?
Yes, I think that one of the challenges of working in a venture capital team is balancing disruptive technologies with relevant technologies, and to really ensure that the technologies that we're looking at make sense for the business. It's so important, the due diligence process, to bring in business line leads, people with real estate experience, and with my prior experience as well, I can typically help on that in the due diligencing. I think that to overcome some of the challenges of gaining adoption and change management is very difficult, is to get teams within business lines to get involved with product development. So since we typically invest in seed and Series A companies, there's a lot of opportunities to help shape the product development roadmap, which gets a lot of people excited because they feel that they are invested in helping these companies grow and using the technologies and testing and vetting them.
Patrick?
I think of engagement and adoption like a gourmet meal. So it's a bunch of different component parts that you need to put together, and when it takes off, it's very satisfying for me. But referencing how diseases pass through populations is an interesting analogy, right? Like, you have to your point, Raj, if it's not simple, intuitive, and easy to get, it's hard to pass it through the population, right? So that's an important ingredient in that gourmet meal. And then, yes, like, people need to be aware of it, right? Like, you need to create collisions and interactions within the population so that people can transfer it back and forth, and hopefully it passes through that population very quickly. But some people might be immune to it over time, and you kind of have to factor in that and kind of think about how you're creating new collisions as it goes through a population. So there's a bunch of different attributes to engagement and adoption that I think we try to think about. And to me, it's not just educating, it's also creating a buzz and like a word of mouth, right? You want people in your organization to go say, hey, did you hear about this? If it's just dumped out there and everybody has access to it, it's like, overwhelming. So I think you kind of want to use that as an ingredient too. So I think it's a really, really important component of what we do, and getting this this adoption and engagement of the various different tools out there. And we think a lot about what those ingredients are and how to put them together.
Sandy, so you mentioned before the specific allocation for what you get from the outside and what you invest in internally. How do you decide what to buy, what to build, what to maybe invest in order that it will be able to fulfill your
It's a
needs?
combination. We spend quite a bit of time talking to the users to understand the business requirements, and we'll put together a design specification, and then we'll see if it's available in the market and if it makes sense. And for us also to invest in outside technology, it has to be a very open platform, because we want to be able to exchange data back and forth. So there are certain business criteria that we have, aside from just the usability and the technical specifications that come along with it.
Raj.
So I think I would much rather always buy than build. But the reality is right now, 75% of our initiatives are build initiatives, and 25% are buy. And I think there are a few reasons behind that. I mean, of course, you'd much rather buy. And this is, I think, important for this audience. Time to market, project risk, all of those reasons, we're almost aching to buy and not build. But because of not fitting in holistically into our platform or our strategy, we are forced to build. And I think a lot of times in commercial real estate, and I spent 20 years in financial services, and I think one of the cultural differences is when you're a technology vendor, there's almost this assumption that I've got to just buy, and it's just a question of who am I buying it from. We have a very serious option of build ourselves. And sometimes just from a fitting into the overall bigger picture point of view, or whether it's something that is exactly in line with to Sandy's point about our business requirement, we're forced to build. I've got about 200 technologists, and when a 10-person startup comes to me and says, do this because this is how you're supposed to do it, and I internally am processing it, I'm like, I can just build this myself. So my recommendation is, right, I think build versus buy, and if you're a service provider, take that reality into account, that the bigger firms, the JLLs, the Cushmans, the CBs of the world, right, they can build it themselves too. So for me, it's almost always buy, but we wind up building a lot.
And I'm going to actually agree with you. We didn't invest 75% by choice. It was literally because we didn't have the right alternative to find a solution that could handle some of the complexities of our business. So I'm right there with you, Raj. I would much rather buy and just work on integrating the different platforms.
Jake?
I agree. We have over 100 different technology partnerships with third parties that we're pretty proud of. We think it allows us to do more on the technology front if we buy. But the unfortunate part, to echo what they're saying, is that anything that's core that we're going to roll out at a national level has to fit in with what our technology platform that we've already created. And so if it's not out there, or if we can't find something that fits, then we end up having to build internally. And typically it takes longer, there's risk, all these things that Raj had mentioned, but it's just a matter of fact. If we can't find something and it's a need, then we have to build it internally. I do think that the CREtech companies that are here today and others that approach us need to be more aware that, and part of their pitch needs to be how they fit in with the other things that we're doing, because most of them are aware of the investments that we've made, whether it be internally or externally, and how they fit with that. And I think I rarely hear that from them. It's all about the individual platform and how it works and all the things that they're doing, rather than how it integrates with the larger picture.
So everything we've discussed so far sounded pretty pragmatic, like going back to our team, seeing what they need, asking them, choosing things that would make sense to the people who are already there. And I'm going to throw this one to you, Andrea. It seems that this approach on its own, assuming that's all that's being done, is actually going to miss out on a lot of stuff that maybe the people that are there might not be comfortable with or might not be able to think about, but that is still very relevant for your business. And, for the future and evolution of your business, if you want to protect yourselves from, from disruption or to stay relevant, how do you balance these two things? Like catering to my team and their needs and giving them stuff that they can use, but at the same time also investing in things that maybe my team will not be uncomfortable with or maybe will see as a threat.
I think any time you buy, build, or invest in something new, it's going to make people uncomfortable. We work in a very traditional industry, and people are, a lot of groups are very resistant to change. And so, as I mentioned before, getting teams involved with product development is very important. For example, we've invested in this amazing COI automation platform called Jones, and we work very closely with our property management teams to put something together that works for the property administrator and the property management, and that's going over very, very well because it's a young team, great technology platform, amazing tech team, and so they can actually do product development changes on a weekly basis. I think that what we've seen with more established companies that you buy off the shelf, you end up doing product customization, that can take significantly longer because their tech teams are probably, and their tech platform is built on a much older legacy platform. So I think that working with some of these new tech companies, these startups, they can just do product development much faster.
Patrick, you seem to be thinking deep thoughts. So
so which part of the question, the buy or build, or the how do you gather requirements?
I think the balancing, basically coming to terms with the fact that if you just ask your team what they need,
the
you
resistance.
might end up,
Yeah. Well, I'll try to tie both together. So I'm highly skeptical of the build. There's a tendency to want to build for sure within our development teams, and I think about can we legitimately build and compete? Like that's something that I think about a lot. And I've seen companies build something, and as I came from the business side and moved into this role, I think one of the strategies I've effectively deployed is to buy and take advantage of companies' technological debt, because once they build something, they have a really hard time getting that team to move on to the next thing and really having the epiphany that what they developed 10 years ago is just not relevant now. It's not effective in terms of what we're trying to do. So I'm skeptical of that. I also think there's an advantage to the buy in that you can use proof of concept, early stage concepts to get to the right stakeholders so that you can get real feedback, because each stakeholder has a different perspective, right? My broker has a perspective that's very important. I need to understand that. The client has a perspective that's very important, and I need to understand that. The operations side of the business has a perspective, and I need to understand that. The further away I get from that, the more likelihood that somebody in that communication chain is putting a filter on the information and presenting their view on it, and that may or may not be in the best interest of all the constituencies and the greater vision of what we're trying to do as an organization. So I think that would be kind of what I would, suggest in terms of how we approach it. And you do have to have a bigger vision. You have to get everybody aligned that this isn't about one individual in an organization or one super team or one business service line. This is about something bigger than that, and it's bigger than me, and it's bigger than you, and kind of get them there, hopefully, to start to reduce the potential inertia and resistance. And then you also have to organizationally give yourself opportunities to create autonomy and put these little proof of concepts in teams that have runway and that have the freedom and are sort of outside the traditional cycle of like how the business operates. So I think all of that together is kind of how we look at that and how we try to progress that front for the company.
Jake?
So the way that we look at investing in technology, we actually have 3 buckets. So it's early, kind of like the 0 to 2 year, what we need to stay ahead of. And those things are typically sales enablement, workflow products, collaboration with our clients, et cetera. And that's most of the feedback we get from the offices and the individuals at our company. But that's one of 3 buckets, and we try to distribute somewhat evenly in those other 2. So there's kind of the medium and then the long term, so the 2 to 5 and then the 5 to 10 year bucket. And those things are like AI and blockchain, AR. And so we're always, if we were to just listen to what is out there in the field, it's what's going to help me today. It's the faster horse that they're going to ask for. So we need to have that longer term vision and understand that, yes, we need to address the needs today, but we also need to invest in the future. And if not, we're going to be left behind.
Thank you. Anna, do you wanna add?
So I spent the first 20 years of my career in financial services, and there are a lot of parallels where investment banking and financial brokerage was in the mid-90s and where I think commercial real estate is. And if you look at the successful firms and their on the financial services side, there was a heavy build in them. And the reason I think that happens is the firms that succeeded, and we know their names on the investment banking side, had technology that gave them an edge, but also, most importantly, let them build a holistic platform that did not have silos. And the reason why we've grown to 1,000 people is our market has matured. We had cash bonds and we had derivatives. We used to have office space, and now we have flex space, space as a service. These are just derivatives of an asset type. And the sophistication of the market is resulting in this investment in technology. And so we've got a model that worked or has been successful, and we've seen who's won and who's lost. And I think we should probably look at a little more at financial services and building new marketplaces, providing more liquidity, better service to clients. The broker of 1995 versus the broker of 2018 at Merrill Lynch, how is he different? And we've seen this play out once before, so I just want to kind of add that.
I mean, you brought up flexible space, and actually an interesting segue into a separate topic. I think everything we've discussed so far is really how to make my existing business better, how to kind of stay within my existing business model, but save time, save money, keep my employees happy. It seems that maybe the biggest risk to any business is not necessarily someone else doing the same business better, but actually someone else coming up with a completely new business model that makes your existing business basically much less relevant. And we're seeing now some of the flexible office operators, I mean, WeWork, chief among them, basically through the fact that they can go directly to consumers and to tenants, not needing brokers anymore, or even setting up their own brokerage. How do you, in your innovation efforts, stay mindful of these type of more strategic shifts and not kind of get bogged down in just, okay, how can I make my operational stuff better today or keep my employees happy? So
2 things. In financial, again, I've spent 25 years doing it, so I've got a strong bias, right?
Yeah.
In financial services, you had sell side, buy side. You had investment banks, you had hedge funds, and they were on opposite sides of a trade. Today, hedge funds are making 2-sided markets. Right? And as far as flex space is concerned, in my view, this is just more liquidity in a marketplace. Mm-hmm. It's tighter spreads. It's more turnover. And so from a conceptual point of view, I think this is something that we all should welcome. This is not a zero-sum game. This is better service. Again, we're in the business of matching yield to risk. Right? It's a marketplace. Right? If someone needs flex space and someone needs a cap rate, a tighter spread is good for all of us. It's a healthier market, so welcome it very much. I'm not going to name names, but as far as I think what these firms have done, they've, I think, done 2 things: is made the next tick smaller, and then they're leading with technology. I think things like amenities and tenant engagement, there's a lot of good stuff happening there, but I don't think there's serious barriers to entry. I think whoever controls the inventory, the landlords, the large firms, flex space is, I think, an option available to everybody. So welcome it very much. A lot to learn. So I think it's good for us.
Thank you. Sandy, in your business, more on the mortgage side, how do you guys keep thinking about, again, not just doing your existing mortgage brokerage business better, but about the type of models that might make the brokerage completely
Well, and I think really
unnecessary.
that's the heart of why we're investing in technology, because with data being so openly available, anyone can do the search and find an asset that they're looking for. It's bringing a level of expertise and knowledge that comes from 27 years of experience. It's being able to have the history that we have and look at things differently to change the paradigm, to be able to close faster, understand the exposures in a better light, and bring the buyers and sellers or the landlords and the tenants together in a quicker way, because we've got to evolve or we will all be out of business at some point, because technology will ultimately be the differentiator and how we each leverage and use the technology.
So to continue with flexible space, so you guys invested in hotel. We know that CBRE are launching their own kind of flexible office effort on that front. Andrea, for JLL, assuming that they want to kind of reinvent part of their existing business, is that something that falls under JLL Spark? Are you guys participating in discussions about these things, or is it more a narrow effort to invest in the technology?
JLL Spark's just investing in disruptive technologies.
And I'll stay with you. So when we think about how all of this evolves, I mean, everyone wants to kill the middleman in all sorts of ways. It doesn't mean that they're going to succeed, but they all want to. When you envision the brokerage of the 21st century, what kind of company that is? Like, what kind of capabilities does it have? What kind of things are proprietary to it? How does it stay competitive and relevant in a market where everyone can reach out to each other, everyone has access to more information, everyone has access to more capital?
I think that technology can only empower the broker to be able to deliver better services for their clients. I think that it also makes the value of a broker much more sophisticated, because they now have real data, real information, coupled with relationships to make, to deliver the best solution for clients. And I think that real estate is still very much a people business. And I think that now it's people powered by technology. So you can negotiate better rates. You can find, based on your relationships, you might only know 70% of the real buying set of viable buyers out there, and I think that the technology will help you uncover the other 30%. I think that technology allows and enables brokers to focus on the much more complicated transactions, the sophisticated transactions that involve so many different players, that technology just allows things to be done much more efficiently, much more transparently, and you just have everything just set up in a way that makes a lot more sense.
Sandy, what's your vision for Meridian 2025?
2025, I think if anyone is going to be thinking 5 and 6 years out, they're fooling themselves, because the technology is changing too fast. Really, again, I think it's all about, for us, it's getting to the data, using artificial intelligence, machine learning to see patterns and trends quicker than anybody else, and being able to just make our brokers smarter and more efficient in what they do.
Patrick.
I agree with a lot of what's already been said. I don't think the middleman will be removed. I think the middleman's there for a really important reason. We haven't touched on trust, right? As the complexity and size of these transactions increases, the level of trust with which the customer is looking to make the trust level that's built over time that allows the customer to make these decisions with confidence. These are long-term decisions that have big operational impact. They cut across people and property, and they're high stakes. And you want to have a team that has the best tools, the best data, and the best experience, and can give context to all of that. And I think technology will really enable those individuals to shine in a very different way. And to Raj's point, financial services is probably a good analogy, but there's a difference between Goldman Sachs taking you public and, a stockbroker from 1984 that was had a Rolodex of high wealth individuals, and I think there will be differences in terms of how those two businesses or segments operate within the broader industry in 2025. So we should anticipate that.
Completely agree with Patrick and the other panelists. But the key thing is, I think the brokerage that has the ability to build the technology of the Merrill Lynch versus the broker that is out of business today is going to be the differentiator. And for me personally, in our firm, I've been with Candor for 20 years, and we built our technology mostly. And on the financial services side, 1994 was when I did my first stock trade. I picked up a phone, I called somebody that somebody had given me a number for, and a month afterwards, I got a statement that said I owned X number of shares, and I think my commission was $100. And we don't do that anymore. We take out our iPhones and we pay almost nothing as far as brokerage is concerned. But overall, there are good players and there are bad players, but the brokerage business is making much more money today in financial services than they did in 1994. The differentiator is execution in individual firms, but not the industry. The need for the broker is going to increase because the complexity of regulations, the global nature of our business is going to need us to be more, the need for the trusted advisor is only going to increase. So I don't think killing the middleman is going to happen.
Well, let me just throw one thing in there. Well, you can do a stock trade very quickly. Doing a lease trade or a sale trade, having the contacts for an expediter to get permits, you still need the relationships and the people to do that kind of work that the regular person cannot do to make a transaction happen and close.
Okay, and just in closing, Jake, you have the opportunity to give us the final vision.
Thanks for the pressure. Yeah, I think that the role of the broker won't go away, but it will change over time, just like it has in financial industry or a variety of other industries. We're going to continue to invest in technology. We're going to continue to innovate and change with the industry. We're a service company, just like an accounting firm or a law firm or all these other services that exist. So the idea of us going away, I just think is it's kind of a lofty idea, I guess. So as long as we change with the industry, which I think the investments that we talked about today show that we're willing to do that, brokerage is going to be around. It's just the service that we provide will change as the industry does.
All right, well, we'll all have to wait and see. Ladies and gentlemen, if you can give a big round of applause for our panelists.